Happy Friday, people. Today is June 30th, 2023. Last day of the quarter, last day of the first half of the year. And we just got the personal consumption expenditures data in this morning. And what do we've got? Another big drop in headline inflation. And yet core inflation remains sticky high, stubbornly high. We have the headline year over year number for PCE came in at 3.8% year over year, slightly below market expectations of 3.9%. But core PCE inflation, which strips out food and energy because those things are volatile and the Fed likes to look at inflation without food and energy, well, that came in at 4.6% year over year, slightly below the 4.7% expected. So we've got this core inflation remains stubbornly high, sticky high at 4.6. It's been bouncing around between 4.6 and 4.7 for several months now. But there is one flaw in the data that is skewing these numbers. And if you've been following this channel, you probably know what that is. That comes down to the rent. They're overstating the rent in personal consumption expenditures, much the same way they are in CPI. Now, I'm not as familiar with PCE as I am CPI. That's the more common inflation gauge. But I went and I looked at something called the rent of tenant occupied non-farm housing and the personal consumption expenditure. And they're saying that the rent year over year is up 8.7%. And that's very similar to some of the numbers that we're seeing in the CPI math. And that is a very big weighting, a very uh, heavy influence on the core number. Now, the problem is that number does not line up with what we're seeing in Zillow, what we're seeing in Redfin, what we're seeing in Apartments List. The asking rents in the United States, the asking rents, not what's locked into a lease already, but if you're actually right now in the market to rent a place, the rent is flat year over year, or in some areas, it's actually falling. And none of these inflation measures are yet to reflect that change. They're still using, these are still lagging indicators using old data. And it's still showing that increases in rent are rising even faster, but the actual information on the ground is very different than that. And what does that mean? It means the Fed is still fighting inflation that is not anywhere near as high as they're saying. In other words, the Fed is making a big policy mistake. They're over tightening, something we've been talking about for a while on this channel. Yes, inflation is still high. Yes, prices have risen, but they're not going up anymore. If you look, you're still dealing with last year's price hikes. The price of everything is still higher than it was 2, 3 years ago, but those prices are not going up anymore, or at least the rate of increase has slowed drastically. And nowhere is that more apparent in rent. And if you think I'm kidding, talk to any landlord, any Airbnb host, anybody who is trying to generate cash flow from a rental property right now. It is not as easy as it was a year or two ago. Elsewhere going on in the markets today, we've got Nike earnings came in. Nike getting crushed. I don't know about crushed, but Nike not having such a good day. Their revenue came in 12.83 billion versus 12.59 billion expected. Now, the revenue is up about 5% year over year. That's a pretty good number, but it's the earnings and the forecast that are hurting Nike. Earnings per share came in at 66 cents a share versus 67 expected, but that is down 27% versus the same quarter a year ago. So we've got revenue is up, earnings are down, way down. What does that mean? Margins are getting squeezed. And right there, guys, that's another indicator that inflation is not as bad as it was. If Nike still had pricing power, if they still were able to pass these costs on to the consumers, then their margins wouldn't be compressed. You'd see their revenue rising like it is, but you'd also see their earnings rising like it is. But it's not happening. The earnings are not going up because Nike cannot pass those costs on to the consumers. The consumers don't have the money to pay for it. The solution to high prices is high prices. And we're seeing it in discretionary items like apparel. People are not paying up for this top of the line apparel, and it's hurting Nike. And elsewhere, what else we got going on today? Uh, uh, Today, this afternoon, it's expected that we hear from the Supreme Court about student loan forgiveness. That could be a big wake-up call to a lot of people. 1 in 10 adults in the United States has an average of $400 a month in student loan payments coming back. If the Supreme Court strikes it down, we still don't know which way that one's going to go. Also, it's the end of the quarter. Keep your eye on reverse repo, guys. $300 billion has come out of the reverse repos over the last few weeks, really since the debt ceiling deal was happened. If you're not familiar, reverse repo is basically excess cash in the banking system that banks have been parking at the Federal Reserve in this reverse repo, earning basically free 5% interest. Well, that extra money, it's money that was printed in 2020, 2021, is starting to trickle into the economy. And when that is gone, when that is all used up, that's when, well, if you ask me, that's when all hell breaks loose in the banking system, but we won't know until that happens. But the drain has been pulled on that bathtub of extra water in the banking system, and it is draining fast. Now, we typically get a spike in reverse repo at the end of the quarter, so we will see that number go up today in this afternoon's number, but then it's going to start falling rapidly next month. How far it falls, how fast it falls, only time would tell. And with that, let's thank the sponsor of today's live stream, Patriot Gold Group. Guys, we're going to talk about banks. We're going to talk about central banks. And of course, we have got market at all-time, not all-time highs, but bubbles, the everything bubble. Everything is overpriced, overvalued. People are paying way too much for it. We know there is a reckoning coming. When that reckoning finally arrives, you will thank yourself if you own physical precious metals like gold or silver, because it is the best way to protect yourself from central bankers and from greedy banks that make terrible decisions, that are lousy custodians of their customers' money. So why not unbank yourself through the ownership of gold and silver? So go to nsfgold.com. There's a link down below in the description, or call 888-988-5401. Get your free investor guide today. And of course, tell them that nobody sent you. And with that, let's shrink my big melon of a head and see what's going on in markets this morning. First things first, Fear and Greed Index, CNN's Fear and Greed Index, currently at 79. We touched 80 just a few seconds ago. This market is frothy, to say the least, way overvalued, way overstretched. There is a correction coming. It is inevitable. This index has been pretty good. And guys, if you go back and look at the timeline, anytime this has been up in the 80s, there has been a significant decline in markets that followed, currently right around 79.80. Looking at the S&P 500, currently up 36 points or 0.83% this morning. Stocks are liking this PCE data. S&P trading at 44.33. The Dow is up 186 points or 0.55%, trading at 34,309. And the NASDAQ leading the way higher, up a full percent. It is risk on in stocks, trading up 143 points or 13,734. And look at the US dollar today, giving back almost all of its gains from yesterday. The dollar market is not liking these lower inflation readings, because while yesterday the market was pricing in a more aggressive Federal Reserve, right now it looks like the DXY is starting to factor in maybe a slightly less aggressive Federal Reserve. The DXY trading at 103 even, down 34 basis points. And you see it in bonds also. We've got rates are lower virtually across the board this morning, although it's marginally lower. The 10-year is unchanged at 3.85. The 2-year, after ripping higher yesterday, has given up just 1 basis point, 4.86% on the 2-year yield. So the bond market is not really reading too much into this PCE number, not like the Forex market is this morning. And looking over in commodities, it looks like we got something similar. Gold is down about 15 cents this morning, $1,917. And silver at 22.42, down 17 cents or 0.75%. And we've got crude oil is just fighting its way back above $70 a barrel, at up 27 cents this morning or 0.3%. Rounding out the commodities, we've got natural gas unchanged on the day at 270. But here is the top story this morning. Trading economics, U.S. PCE price index annual change. Personal consumption expenditure price index in the U.S. increased 3.8% year on year in May. That's the lowest reading since April of 2021, compared to a downwardly revised 4.3% advance in April. Prices for goods increased 1.1%. Prices for services rose 5.3%. So there's that services inflation that Powell says he wants to see come down. Food costs went up 5.8%. Energy prices decreased 13.4%. And excluding food and energy, PCE price index, which is the Federal Reserve's preferred gauge of inflation, increased 4.6% from a year ago. That compares to market expectations of 4.7% and a 4.7% read in April. On a monthly basis, PCE rose 0.1% and the core index 0.3. And you can see here, this is the headline year-over-year change in PCE going back to the same time a year ago. It has been falling fast, guys, and it continues to fall today. Now, looking at core PCE, this is an interesting chart because we've got 4.6, 4.7. It's really been bouncing around at this 4.6 level for about 6 months now. But if you look at a 5-year inflation chart, this is kind of what Powell was referring to when he said sticky inflation. When he sees core inflation staying high, that's people just getting accustomed to higher prices. So Powell probably won't like this sticky high core PCE inflation. But again, the big problem with this core inflation number is it's overstating the increases in rent. They're factoring in an 8.7% year over year increase in this rental of tenant occupied non-farm housing. Guys, the rents, if you look at what it actually costs you to rent a place right now, I know if you signed a lease 6 months ago, that doesn't affect you. But if you're in the rental market right now, the rent you're going to be paying is going to be comparable to what you were paying a year ago or 6 months ago. It stopped going up because people just can't afford it. So they're still overstating core inflation. Looking over at what's going on in Nike this morning, check this one out. Oh, wow. We just found Nike posts first earnings miss in 3 years as lower margins hit sports apparel giant. The fourth quarter revenue beat Wall Street estimates, but its profits fell short of expectations. The sneaker giant's margins fell 1.4 percentage points during the quarter, and inventory was flat from the prior year. I want to zoom in on this right here. Nike's gross margins fell 1.4 percentage points during the fourth quarter to 43.6%, contributing to the earnings miss. Margins narrowly beat analysts' expectations of 43.5%, according to the street. The companies attributed the drop to higher production input costs, elevated freight and logistics expenses, higher promotions used to clear excess inventory, and unfavorable currency exchange rates. And guys, this thing right here really does not pass the sniff test with me. Elevated freight and logistics expenses. They're citing that as the reason why their margins are compressing. One of two things are going on here, guys. Either Nike made a horrible, horrible business decision and locked in their freight rates at all-time highs back in 2021 when, remember, the congestion at ports and you couldn't get anything across the ocean, and container rates were so high. Well, those numbers have fallen. They have fallen precipitously off a cliff since then. And almost every other company in the world right now is reporting lower freight and logistics expenses. So for Nike to come in here and say elevated freight and logistics expenses are squeezing their margins, Nike is either the victim of a horrible decision or they're just outright lying here. They're just making it up. I don't know what's going on, but even CNN or CNBC here is calling them out on this. Other retailers that reported earnings recently noted freight and logistics costs had gone down for them, providing a boon for their margins after supply chain headaches subsided. So something in Nike's quarterly report here just doesn't pass the sniff test. They either made a really bad call or they're just outright lying. And this morning, Nike stock is down 2.6%. So they are paying the price for this one. Something else I want to talk about, guys. Remember those stress tests yesterday? Remember when the Federal Reserve told us, remember, strong and resilient? What a shocking outcome for the stress test. Well, they told us yesterday that America's top 23 banks had weathered a 40% decline in commercial real estate prices, a 38% decline in home prices, and a 10% surge in unemployment. This was a fictional scenario that the Federal Reserve, kind of like a war game for banks. And they told us that the banks were able to weather that storm and that there was only about $500 billion lost among the 23 largest banks. And I said how that number just didn't pass the sniff test, that there was just no way the losses would be that small during an economic downturn that big. And then this morning, I see this in the Financial Times. Bank of America nurses $100 billion paper loss after a big bet on the bond market. The sum is more than double the cost of other U.S. lenders that channeled flood of deposits to cash. Now, what they're talking about here is unrealized bond losses. Bank of America bought a lot of U.S. Treasuries back in 2020 and 2021 when interest rates were low and when stimmy cash was flowing and everybody had more money in the bank. Bank of America took that money and bought bonds. Well, as interest rates have risen thanks to the Federal Reserve, those bonds are down in value. And Bank of America alone is looking at a $100 billion loss on those bonds. Now, this is just more example right here. before the crisis even starts, because we don't have the big decline in commercial real estate, we don't have the 10% surge in unemployment, and we don't have the 38% decline in residential real estate. And Bank of America already has 20% of the total losses from this fictional Fed scenario that was reported yesterday. You see how the Fed stress test yesterday was just this meaningless PR stunt aimed at shoring up confidence in the banking system. It was fake. The results of that stress test are not realistic. The losses in the banks are already as big as the losses they were saying in that fictional scenario, which was just god awful. Bank of America is bearing the cost of decisions made 3 years ago to pump the majority of $670 billion in pandemic era deposit inflows into debt markets at a time when bonds traded at historically high prices and low yields. The move left BOFA, the second largest U.S. bank by assets, with more than $100 billion in paper losses at the end of the first quarter, according to data from the FDIC. That sum far exceeds unrealized bond market losses reported by its largest peers. So again, guys, if you've got one bank already lost $100 billion without the 10% surge in unemployment, without the 40% spike in commercial real estate, and without the 38% loss in residential real estate, then how big would the losses realistically be at any of these banks? Guys, Bank of America's losses alone would be more than the 500 billion that they reported yesterday in the event of this economic doomsday scenario that they painted. So again, I can't tell you enough. This stress test yesterday was such a PR stunt. It was a scripted outcome, and just they're going to point to it and congratulate themselves on a job well done. Just understand it was meaningless. And last thing I want to talk about is this one. This is the overnight reverse repos that I was talking about, guys. We're going to see a spike in this number today because it's the end of the quarter, and you usually get that. But I want to just zoom in on these last few weeks. Really, since the debt ceiling happened, the debt ceiling was done on about June 1st was when they had the deal. All right. At the end of May, reverse repo was at $2.254 trillion. Right now, it's at 1.934. So over $300 million worth of this spare liquidity has been drained out of the reverse repo. And this is the cash cushion of the banking system, is what we're looking at here right now. This is money printed in the 2020s that was just kind of set aside in the banks, and it wasn't ever really spent into the economy or loaned into the economy. It's just been parked at the Federal Reserve. So this is one reason why we haven't seen any turmoil in banks or this big spike in interest rates or this big spike in the DXY since the announcement of the debt ceiling deal, because all of the extra money that the government has been borrowing, Janet Yellen has been issuing new government bonds and borrowing the money from the economy. It's been coming from the reverse repo. When the reverse repo runs dry, that's when the rate hikes, that's when the rates start skyrocketing and when the dollar starts spiking. It could happen sooner, but for now, the reverse repo is absorbing that blow from the Federal Reserve and the Treasury. All right, guys, I just have to say a thank you to, where are you, sir? I saw somebody come in on a super chat there. Hey, Steve what's going on, brother? Thank you, sir, for the super chat. He says, still haven't seen the lag effects of past rate hikes. The Fed will probably hike again. What could possibly go wrong? I do think the Fed is probably going to hike again. The market is pricing in something like 80% likelihood of another rate hike in July. So I do think they're going to hike again. And I think it's going to be a mistake, Steve. And, you're right about the lagging effects, but I think we're probably starting to see some of the lagging effects of those monster 75 basis point hikes from last summer. Remember that first 75 basis point hike just turned 1 year old a couple of days ago. And we're already starting to see it, $300 billion draining from reverse repo. All right. So that is liquidity already starting to dry up in the bond market. Now there's plenty left. There's still almost $2 trillion sitting in reverse repo. But when that's gone, that's when the liquidity crisis happens. And at the rate governments are debt spending right now, at the rate deficits are growing, that $2 trillion is not going to last very long. So keep an eye on those reverse repo levels and keep an eye on the market's reaction to it. When you start hearing more about it in the mainstream press, when they start saying, oh my God, what's happening? Reverse repos are dropping. That's when they're starting to get nervous in the bond market, and you really got to worry about it. Thank you, Steve, very much for the super chat, sir, and the support of the channel. Thank you, everybody, for your time. By the way, this is my last day on the beach, my last day of vacation. I will not be doing an afternoon live stream today. I'm going to be spending time with family. So I will see you guys again on Monday morning. I'll be back at Melonhead HQ. I want to say thank you for your time for watching. Thank you to my Patreon supporters for everything you guys do. Thank you to Patriot Gold for sponsoring this stream. Links down below to all that good stuff. Hi, Mom. Hi, Dad. I love you guys. And I'll see you guys next time. Till next time, live small and dream big.